Good morning to all the participants who join in on this webinar on this Saturday morning. Thank you so much for taking your valuable time out and joining into this broadcast. We have a very special guest with us today, Mr. Manish Gunwani, who is the CIO equities at Nippon India Mutual Fund. Just a little bit about Manish before we get started. He was previously the Deputy CIO at ICICI Prudential Asset Management, and under the assets that he saw there, the AUM actually grew fivefold in a very short span of time. So it was a very commendable achievement and a stint that he had there. He's been a technology entrepreneur. Much like me, he's worked on the sell side almost 2 decades back at a couple of assignments. He is from IIT Madras as well as from IIM Bangalore. So a very rich educational background followed by multi-diversified work experiences. And the last 2 decades have predominantly been on the fund management side. So Manish, good morning. Thank you so much for taking time out to do this broadcast. Much appreciated. Just wanted to start off by getting your thoughts on the last 3 months. I mean, how have you read the complete drama that we have seen in 3 months? The Nifty going from 12,500 to 7.5, then bouncing back to 10, and now where we are. Are we really that detached? Is the market really that detached from the economy as you see right now, or are we sort of, have we become inherently so pessimistic that we just want the market to go lower?
First of all, thanks for the kind intro. Yeah, it's been tough. As in, to be honest, as a house, if I talk about at a aggregate portfolio level of our entire asset management business, I don't think we were positioned for it, to be honest, because this came out of the blue at a point when 2018 and first half of calendar year 2019 were pretty bad for the Indian economy. And then the global economy started picking up, the Indian economy started picking up, we started getting a bit of stimulus from the government. And since September 2019 to Jan 2020, actually all the indicators were that we were in recovery mode. And this, in a sense, came against the run of play, if you can call it that. So we were positioned a bit more cyclically than we should have on hindsight. I think even the market was obviously starting to feel that the economy is coming back and all that. So I think the first reaction of the market in a crisis like this tends to be that don't look at P&L, just go to the balance sheet because you anyway don't know what next few quarter earning is going to be. So that is why I think you saw massive selling in financials, which by definition are leveraged entities. So if someone is leveraged 1:10 like a bank or NBFC, it is simple logic that anything can go bad in that balance sheet. So why should you value these banks or NBFCs so high? The other part was we saw that in every sector again, clearly the larger company or the best balance sheet got some protection, whereas a lot of the weaker balance sheets got taken to the cleaners. And I think that is logical. That is very logical given that it is probably the biggest shock we've seen in our lives at the velocity at which it came. So while the financial crisis was similar, this happened overnight, and it probably, the intensity of the GDP effect is obviously much more than the financial crisis, because never have we seen sales go to zero for businesses. And that is a very, very weird period for any business, maybe once in a century kind of event. So I think most of us, the way we have responded is similar, that first you tend to go to the better balance sheets in every sector. Second, I think as portfolio managers who are benchmarked, I think it's okay to be a lower active share, or basically your deviation from the benchmark you cut and get closer to the index, because while you can say that consumer staples and all will do well in the next few quarters, it's also priced in. So there's no big sector call you can make at this point of time, to be honest, in the sense that whatever will do well for next few quarters, the price action has already captured that. So I think we are at a very interesting point. Overall, I think that that if you are patient enough, some of the cyclical stocks are cheap, but you have to believe that in, let's say, and the reason I'm saying is not because I can forecast that the economy will come back in next 6 months or 9 months or 12 months. All I'm saying is the ask rate is low, in the sense that in a lot of the cyclical industries, even in 2 or 3 years, if the economy comes back to where it was, you will make 50, 75%. And that is not a bad return in an economy where I also think the interest rates are going to be very stable and low. So yeah, it's been a pretty interesting 3 months in that sense.
It's probably a very tough job to hold right now, Manish, being a fund manager. I mean, a lot of what is going to potentially happen may or may not depend on the outcome of a medical solution. And I think as finance professionals, it's something that we cannot predict. So how do you approach investing at a time like this? Like you said, cyclicals are looking cheap. Staples are probably priced for perfection. How do you build a portfolio at this time when you really don't have control on the outcome of what is actually unfolding, and the risk of going wrong could be as high as probably the risk of going right? It's sort of a toss of the coin. So given that it's such a tough job to be in your shoes, how, and it's such a binary event, I mean, obviously what you're saying, all bets go off if god forbid you have a second wave in the winter of 2020. So
Yeah.
how do you approach it? How do you construct a portfolio at this time? How do you tell investors what to do?
Yeah, Rahul, that's obviously the fundamental dilemma we have. But I think there are also some clearer bets you can make at this point of time. So let me just divide the stocks which got, or businesses which got impacted by this virus, into two parts, or three parts rather. So one is the set of business which provides a fairly a stable service or good, which is not likely to get disrupted for next 5-10 years, and it is not very, very discretionary. So I would believe that, for example, auto, aviation would fall into that category, that it is unlikely these industries will go to zero, and there'll be some guy who has to provide these services. I think that is where I'm more inclined to be. The second is financials, which again are a great industry to be in the long term, because they tend to grow faster than GDP. But again, every financial balance sheet is leveraged. Some is 1:5, some are 1:12. And the point about playing a recovery is there should not be any capital dilution too much on the way, or the entity should not collapse. So that way, the financials are a bit of a tricky part for me, because while I believe that whether it's 12 months or 18 months or 24 months, the economic activity will come back to pre-COVID levels, and most of the stocks will do well, even on the assumption that in 2 years we come back. But the financial part, because there is leverage, I'm a bit, I'm kind of in between there. And the third part, I think, is industries which could be structurally disrupted, or where the consumer behavior has changed, or something like that. Now, there's a lot of talk about this. We don't know for sure, but obviously multiplexes, for example, or in a very generic sense, office space itself, because a lot of people are saying work from home will become so big. So let's say owners of IT parks and all may have to worry a bit. There, obviously, again, if you have a differentiated view, you can say that I'll stand against the crowd and say nothing will happen to office space or multiplex. Again, those are tougher bets to make. So to me, something which is very basic to the economy, something which I don't think will change too much with time, which are sectors like auto, maybe aviation, something like that. Those are relatively visible and clearer bets to make. On the other hand, you're correct that while these kind of bets are good for a 2, 3, 5 year perspective and may give you very big return, I think you can't run a portfolio which is very, very skewed to cyclicals as well, because as you correctly pointed out, I think one of the bigger risks remains that in winter, if globally there is again a wave of infections, the cycle may be delayed too much. So on the defensive side, which is a bit tougher because the stocks have been doing well for the last 3, 5 years. So the valuations are not very cheap, but clearly there are spots in pharma, even if consumer staples, apart from 3, 4 stocks. A lot of other stocks, especially in the mid cap space, have fallen or not done anything for 3, 5 years. So yeah, so basically the point I'm making is I think the portfolios will have to rely on bottom up uh, alpha creation within a sector rather than taking extreme sector bets, because for next 1, 2 years, frankly, no one knows what's going to happen.
So let me come back to the market for a second, because you've given a lot of interesting talking points, and I want to sort of dive into each of these systematically. But just going back to the market for a minute, do you think that the market has already started pricing in a recovery because you're already 25-30% off the lows of 7,500? Or do you think that the economy market mispricing that we are probably seeing opens up more of a risk on the downside? What is your gut feel? Which side are we more likely to sort of tilt towards?
So I have 2 or 3 very important points to make here. First of all, I think the market will do better than the economy. I think there'll be a stark difference. There are 2 reasons for that. One is I think we have to accept that globally central banks have been very active. Government fiscal stimulus in developed world has been very active. So clearly, it does look like policymakers want asset prices to remain high, and you can't fight that too much. The second reason, I think is more interesting, is that in India, I think last 4, 5 years, also this trend has been happening because of better compliance to GST, whatever, that the markets has typically in every industry have gravitated towards the top 1, 2, or 3 players versus the third to 100 player. So we've seen it across very basic industries like paints, textiles, pipes. Even in those industries, that is happening apart from big industries like telecom and steel. So what the stock market is essentially a listing of the top players in each industry. So to that extent, when there is consolidation, it will look like the stock market is doing better, which may not be fully reflective of the economy. The third reason why I think the market will do better is this Indian stock market is not just about India, because almost 35-40% of profits come from global. Global side like energy, IT, pharma, etc. And it does look like to me that the global cycle will turn faster than the Indian cycle, because the stimulus in the developed world has been stronger, the monetary push has been stronger, and they have better medical infrastructure, etc., to probably come out of this crisis. So that's the first point, that the overall view I have is that the market will outperform the economy. In terms of how to look at absolute levels, look, I think there are 2 ways I sometimes think of this. If you're a pure theoretical view, then and a lot of us do discounted cash flows, which can give you a very wide range of results for each company's valuation. But the simple point is, on a discounted cash flow analysis, when you look at a company, 1 or 2 years of cash flow actually should not impact it by more than 5%. So to that extent, the COVID, from a very structural sense, should not cause the market to fall more than 10% or 12%, let's say. The other way I look at it is the more frequently used price to earning of the market. I think FY21, there's no point looking at earnings, but if Nifty EPS in FY20 was around 475, 480, I think my sense is FY22 can be anywhere between 525 to 600 kind of levels. And since it's 2 year forward, you give 15, 16 times. My sense was that market will remain between somewhere between 8,000 to 9,500, a kind of range for some time till we get clarity how all of this is evolving. Simply on this metric that on FY22, we should be somewhere around 15 to 18 times kind of stuff. So 8,000, maybe if you want to stretch it, 10,000. Yeah. So to your point, yes, today at roughly 9.5, I think the market is a bit optimistic that things will come back. But I'll be of the view that today we are on fair value zone. Clearly, the upside was much better. Things look easier to talk about on hindsight. So the market was 8,000. Obviously, the upside was much higher. I think we've reached a fair value zone where market is not very pessimistic on the recovery. But from a fundamental basis, as I said, there are a lot of stocks where if their earnings go back to FY19 or FY20 earnings in next 2 years, and they just retrace what they've lost, there is fair amount of money to be made.
Mm-hmm. So when you look at BFSI as a sector, Manish, it's been most fund managers and CIOs I talk to are not sure how much of an underweight they need to be ascribing to this sector because of the concerns. Corporate NPAs were anyway something that we were dealing with. I mean, case in point being, if you just look at the Bajaj Finance stock and the way that's cracked, I think there is probably a story to be told on retail NPAs there. So if you are going to sort of have a 1 to 2 year horizon and go underweight on banks, like you said, consumer staples are probably priced for perfection. Reliance has had a very good run. What takes the market higher then? Because there is not too much of a weight to play outside BFSI, consumer staples, and Reliance. That probably itself is almost 65-70% of the market. So if it was to go higher, what sort of takes this market higher in your sense?
No, I do think that you're correct that both for the economy and for the market, financials have to do well. And I think they will do well once economic activity starts picking up. The only point there is that the usual paradigm was retail sided financials were getting a higher price to book. And the way this crisis has evolved, probably the concern is as much on retail as corporate, if not higher. Because if you look at what's happened to India from 2015, in a sense, we've been in a deleveraging cycle. So first, the power, infra, steel, the large NBFCs, all of these have got resolved or written off or went bad over the last 5-6 years. So the good part about the financial system today is that those NPAs of the size of 30,000 crores, 50,000 crores, 60,000 crores, those have largely been resolved over the last 5 years. So there's not too much of concern on steel, power, infra, and all those big items. So today, I would say the relative call in financials to me is clear that the large private banks which have fair amount of corporate exposure, they probably to me rank the highest because the valuation is also reasonable there. And I can't see how the economy can recover without them doing well. The second is obviously anyone with good liability, even if it's on retail lending, I think they will also do reasonably well. The valuations may not be very cheap. The trickier part is, of course, the NBFCs. There again, I think auto-based, auto-focused NBFCs seem okay to me. I think the housing ones in urban areas, the NBFC focused on housing loans in urban areas which have some exposure to developers. Those I would be fairly cautious about. Um, and the smaller NBFCs, I think, just because the liability side is a bit questionable. So one of the things which could obviously delay this whole recovery thesis, even if you're patient, is if there is a chain of credit events that happens every 3 months, which is what we've been facing since ILFS. So I think that is what I worry about a bit. That although having said that, as I said, the big credit events, most of them have played out. So there are not too many 20, 30, 50,000 crore kind of NPAs which can happen because most of them have happened. But still, I think you can always have some of these entities going into trouble. And if every 2 months you hear of a small bank failing or of a big NBFC failing, that can be a big negative. That, in fact, that is probably the only thing I can see why on a 2 3 year basis you'll not make reasonable amount of money.
Hmm. You stressed a lot on balance sheet in this interaction that we've had. How do you internally manage that? Is there a greater role that your debt or credit team plays when you guys are analyzing companies to invest in? How do you sort of, uh, drill down into looking at companies and making reasonable projections on balance sheets in such uncertain times?
Um, See, you do as much bottom up as you can. You're correct that we also have the advantage of having a fixed income business within our asset management business, and there's a lot of sharing of knowledge. So the balance sheet is not just about the numbers on the balance sheet; it's also about the promoter's track record in treating minority shareholders, in treating debt holders, the group's non-listed activities, right? Sometimes you get hit not because of owning a company which is good in the group, but because the group goes ahead and does some aggressive stuff outside that entity. But finally, this entity also gets embroiled. We've seen so many cases of that also happening. So you need to have a holistic view, not just with the balance sheet which you have exposure to, but also what is the group doing, and in those kind of inputs, obviously having not only the fixed income, but we also have a PMS business which is also dealing with a lot of small promoters. So that knowledge definitely helps. But I think it's also about being in relatively good balance sheet, because I think some of the big money will be made, and this is a theme we are trying to play, that you're necessarily not talking about debt-free balance sheets. You're talking about, let's say, a balance sheet which has debt, but if in that industry that balance sheet company is a leader by far, and rest of the balance sheets are in really bad shape, it's worthwhile to put small stakes on these kind of plays. So as I said, if you look at tires, if you look at aviation, if you look at textiles, some of these stocks we own with this thesis that it's not that the stock we own has net cash or zero debt, but we feel that the leader's balance sheet is so far better than the number 2 3 and 4 players, that if if this downturn even gets a bit worse, what typically tends to happen in these scenarios is, it's not that we are saying the number 3 or 4 guy will go bust, but their investments in supporting the distribution, in supporting the brands, in supporting employees goes down, and then they tend to make short-term decisions whenever the recovery comes. you tend to lose market share. I mean, a classic case, I believe, was, for example, in 2000 financial crisis. JP Morgan, Citi all went in the same boat, but JP Morgan from 3% market share came back to double-digit market share after the crisis. Or we ourselves saw in the domestic market between HDFC Bank and ICICI Bank in 2007, both of them had probably the same size roughly of the retail business. But someone whose balance sheet went under stress obviously lost out market share for next 10, 15 years to someone whose balance sheet was better. So, so when you talk about balance, it's also a bit relative.
What about pharma, Manish? You mentioned that a little earlier in this interaction. Is it a sector that's going to do well because you are going to see a lot of earnings growth coming, or is it going to be something that's going to see more PE re-rating because of years of underperformance and under ownership? Because when we do our numbers at our firm, my analyst probably believes that the earnings growth will not be as material from here on. He almost believes that most of these, at least from an FY22 perspective, are priced to perfection. So is this going to be more a PE re-rating story because of under ownership and underperformance, or is there something else you're reading into this sector?
So I think there are pockets where, see, in terms of absolute return, no one knows, but definitely from a relative sense. So if you compare it to, for example, consumer staples, and I'm not saying the businesses are same. Obviously, the volatility is very different. But I'm saying even if you compare some of the pharma names where, let's say, 60 or 80% of EBITDA is coming from the domestic market, which tends to be a bit more predictable. The free cash flow yield in some of these names we are seeing is somewhere between 3 to 4%, whereas consumer staples, the free cash flow yield is largely between 1 to 2%. So first of all, you have a gap, reasonably substantial gap in free cash flow yields. And I'm not talking of businesses which are very predominantly in US because US becomes very unpredictable. Even for stocks where, as I said, more than 50-60% of EBITDA is coming from domestic business, you're seeing a fairly big free cash flow yield gap. See, some part of it is explained by the fact that the domestic pharma business also tends to have some regulatory risk in terms of NLEM. But I think the gap is reasonably large. Now, you're correct that I think some part of that difference has played out. Now, maybe the US or rest of world business have to kick in to give you upside on these stocks. But I just feel there is at least an option of making some big money if, for example, some of the US pipelines work. If, for example, rest of the world does okay, because some of them have got hit by emerging market currency volatility. So I think there are some optional values left. Clearly, if stocks have done 50% last 6 months, again, maybe hindsight, but the risk reward was much better 6 months back than today. But I do see a bit of a relative trade here.
What about non-lending, Manish? If I look at your industry, you say life insurance, and I was speaking to Navneet Panot of SBI Mutual Fund last week, and I asked him the same question. At the end of the day, allocations to mutual funds and insurance companies are also through discretionary money. Right? At the end of the day, they're a portion of your savings. Do you sense that there could be a shift from lenders to non-lenders, or do you think that the kind of growth rates that mutual funds and insurance companies have been enjoying, that may also probably in the short term come under some pressure because it's a function of how your savings are allocated?
No, I think short-term pressure will be there. So if I have to look at 3 categories: general insurance, life insurance, and asset managers. Even general insurance, which to me is the best business among the 3, in terms of potential, in terms of the return on equity and sustainability of profits. Even that will get hit because a lot of general insurance in India is linked to auto. Now, of course, the advantage they have is they get premiums from the fleet more than the new sales. So to that extent, they'll be better off. But I think there will obviously be an adverse impact because auto sales are weak. Life insurance, again, part of it tends to be reflexive to the stock market because ULIPs are a bit of a play on savings. And one is, apart from the stock market, I think there is a general tendency what we're seeing in terms of the morat numbers which are coming out when you see credit cards and all, that people just don't want to park, they don't want to give cash away. I mean, they just have this tendency to hold cash at this point of time, where even fairly good segments are not, they're not paying and taking more at from credit cards and all. So I think even for savings, that effect will be there. That even if you have a SIP running or you have a ULIP running, some part of that category may say that let's just hold on for a bit, let's see how things work out, because a lot of people are not sure of the salaries, whether there'll be a salary cut, and let's face it, a lot of them are not even sure of the jobs, that the job will remain or not. So I do think that it's unlikely all these business will not be hit, but I do think long term, as I said, I'm quite positive on general insurance, even asset management. Although asset management, I think people underrated the volatility. It is a reflexive business, obviously. When markets go down, the top line goes down with negative operating leverage. So, but long term, yes. If you assume that even if market to 10% and you get inflows, all these business should be able to compound 12-15% long term.
For your own business specifically, Manish, do you think we've reached a stage where equity maturity has stabilized to a large extent? I mean, do you get a sense that SIPs are almost like taxes that you have to do now, and it's reached a stage where short-term market bounce like this will probably not impact, because gold, real estate have not really necessarily been asset classes to invest in over the last 5 or 6 years. And I'll get to gold a little later and what you think of it. But do you think that culture has reached a certain level of maturity, given the way you've seen the SIP flows pan out for the industry as a whole, not just for Nippon India Mutual Fund, but just as a whole?
Definitely. I think what we've been seeing across 2015 onwards, actually. So we had one big correction in 2015, and then 2018 in small caps, fairly brutal correction. And we've had this correction in 2020. And obviously the flows have remained positive right throughout. So that gives you a good idea of the maturity of the investor. And it goes back to what you're saying, that I think between the big asset classes, gold obviously is done well, but between real estate and with, in fact, recently, if you see the cuts of SBI in the fixed deposit rates, you struggle to think of a time when you've seen these FD rates, right? I mean, less than 4% or something like that. Post-tax, I think the FD rates are really, really low right now. So there is a relative thing. And also, I think as the economy grows, there is a big discretionary savings pool. And if you think about it, if let's say on an annualized basis, we are doing $7-8 billion, we're still a very small part of that savings pool.
What's your sense on the industry as a whole, Manish? And when you look at, say, garnering market share from here, do you guys, will you all have to give higher distributor margins right now? How is the market share game going to play out in the mutual fund industry? I mean, we don't have too much publicly, we don't get to go deep into the numbers of a lot of mutual funds because there's just a couple of them listed, yourself and one of the larger peers in the sector. But how do you think the game will play out amongst the mutual fund industry managers right now, and how will the market share game be played from here? Because I think globally expense ratios are coming down, but I think distributor incentives are probably going up, if I'm not mistaken. So how do you see the evolution of the mutual fund industry itself if you take a 4-5 year view from here?
So typically, I think market share is a three-leg stool between performance, brand, and distribution. But having said that, clearly the role of performance will keep going up versus distribution, because as the digital media takes on, and as people become more aware of these products, people will tend to gravitate towards performance rather than the fact that there's a branch office in your city which is close by, or some stuff like this. What you see in banking as well, right? See, one of the threats to our industry, and it's a big threat, is obviously passive investing. If you look at the West, that's become the dominant trend. And I think we cannot deny the fact that passive investing will become a reasonable part of our industry. Even in India, alpha creation in pockets like large cap funds is become a challenge. But I do think that the last 2 years have been extremely narrow in terms of stock market performance, because the economy has been going through various shocks. If at all we're going to see a recovery, hopefully there'll be a phase where alpha creation will be better for the industry. So long term, I do think that passive investing will become big. In fact, we have a reasonably sizable business on passive investing. But I do think that maybe from a cyclical perspective, a bit of alpha can be regained by the industry. Ultimately, I think the key success factors in this industry are going to be delivering performance in an institutional manner. That is first, because obviously one star fund manager, if he does well, goes on for some time and then it collapses. We've seen a lot of AMCs going through that process. The second, I think, is, and this has happened in the West, may play out here as well, is to deliver multi-asset products which can meet customized requirements of a lot of investors. So I think the good part, which we've been seeing, is that maybe 5-10 years back, to excite someone about equities, you needed multi-baggers and 20% CAGR for 10 years or 5 years or whatever. Today, I think if you can deliver 8-9% with low volatility, and some of the hybrid funds which have been positioned like that have done pretty well. But if you see, even globally, a lot of the asset managers, roughly the three buckets their assets are passive, active equity, and alternative assets. Now, alternative assets has become almost as big as equities. And alternative is basically multi-asset products which deliver a certain kind of return profile, which is kind of customized. So if someone's saying that, look, equities long term may give me 12-15, but I can't take the volatility. So if I get 7-8 with less volatility, I'm good enough. Those are kind of needs if someone can deliver and innovate. I think globally that has proven to be one of the ways for asset managers to do well.
I'm so glad you touched on that, Manish, because it's a topic that's been sort of doing the rounds for some time. Is passive investing, and it's something that's gained dialogue in India in the recent past as well. But when you look at investor behavior, Manish, if you look at, say, the B30 and beyond, do you see that mindset having changed because it's been so volatile? The markets have corrected. How is that part of the market the investor pool behaving, and what is their approach to investing when you and your team go out there and interact with them?
So I think B30 is still a market where the market is getting penetrated. I think the active equity is what is more predominant there. I think the passive equity is more happening on the institutional side or the HNI side. So I think it'll take time for B30. I think B30 is still a very small part of the industry, although it's growing. But I think that there, it's more about asset allocation at this point. People are not, and I think even if you look at aggregate balance sheets of households in India, there are these famous statistics that only 3% households have exposure to equities and all that. So clearly, there, as of now, it's more a game of educating them about existence of equities and its role as an asset class. So that phase is going on. I would think it'll take some time before passive investing goes to B30.
Mhm. Just want to move a little bit into your personal life, Manish. We've spoken so much about the markets and the economy. I want to take you back, say, 2 decades back when you were a technology entrepreneur. Uh, how was it then? What have the learnings been over the last 2 decades as you started off as an entrepreneur to where you are today? Can you talk a little bit about that journey? Do you miss those days of being an entrepreneur? And sort of what are the learnings from there that you have carried forward to where you are today?
Yeah, I think there's obviously a charm, and I did it with a couple of my engineering batchmates. So there was a lot of collegial kind of environment in our startup. So obviously, you miss that. I think the economy was so small then. Now, when you look back at the scale of the numbers, I think so. I joined that business in 2000. We probably what 300, $500 billion economy. Um, IT was 40% of the index after that steep .com boom. Um, and the opportunities generally were not so big. Uh, I think it's a very, very educative thing doing business on your own, because one of the things I think that has remained in my consciousness is that I look at P&Ls with a very skeptical mindset, because I think if you run a business, you will realize that the only thing that matters is the cash flow in your bank, right? I mean, this things like depreciation, P&L items is what you see after the end of the financial year. So one of the things that you carry forward is that a lot of these accounting entries are so ephemeral, right? I mean,
That
versus
is so
what is
true.
actually happening in your bank's account. The second thing, I think, what I have realized is that scalability is so important, because some of I think 95% of businesses start with the hope of making cash flow, but there are only
Hmm.
5% of businesses that can scale to become substantial businesses. So
Hmm.
even when I started, it's not that we took a grand strategy view, that this business was a great business on a quadrant or something like that, right? You just feel passionate about it. You feel that you know something about that market, about that technology. Um, but I think there are very few businesses that can scale, unfortunately. So it's not a democracy that businesses need to do well, all of them. Um,
Right.
and I think as an investor, I think it's very necessary to figure out that a business which has gone from 1 to 100 may not go from 100 to 1,000 very, very easily. As I said,
Mhm.
I think 90-95% businesses don't scale. Um, so you need to be in the rest 5-10%.
Interesting. Manish, you also worked on the sell side before you got into the buy side. How have you seen that part of the industry evolve, having sort of done that and moved into asset management to where sell side is today? I know I'm probably risking a negative answer for my own industry, but do you see us, at the sell side today as being sort of more a value additive, or it's just become so large that at some point it's, at some levels, do you actually think that it's a lot more noise than actually value additive? So how do you think the sell side industry itself, from having been a part of it to now being partners in your business, how do you see sort of this industry and how it has evolved? And what role does sell side have to play, particularly in your investment thesis and when you make your decisions?
No, I think Senside obviously has got, it's been one of those, and maybe you'll pardon me for saying this, but it's been one of those unfortunate industries, which over last 10 years, maybe the top line of the industry has not grown, maybe it's degrown, right? I remember when 2007, I was part of a sell-side output and we did a market scoping analysis. And I think between the prime broking and the main cash equities and all that, it was $1 billion business. I don't think anything much has changed. Maybe it has actually gone down. But I do think that sell-side has an important role in our research process, at least as an asset manager. We own 350 stocks, we cover 550 stocks, and we'll never be able to do that without sell side. But I guess it's also about each firm trying to find its own niche and differentiate. But the good part is, I think actually the Indian sell side firms are probably well placed, because I think globally the MNCs have lost focus on research. Because even in India, if you see, the MNCs, they cover 100, 110 stocks, and India's gone far beyond that to my mind. So as an asset manager, I can say that out of our 20 top brokerages, about 18 are Indian, I think 17 or 18 are Indian. So I think the good part for sell side is, unlike some of the other economies which are so dominated by one or two sectors. So if you were to go to Hong Kong or Taiwan, there's not too much to cover, right? Because those are basically real estate and financial and semiconductor kind of economies. But the good part about India is that the diversity of the industrial landscape is very high, which is why we are covering 550 stocks, right?
Right.
So, and hopefully that will grow. I think the unfortunate part, and I think it's true probably just like auto or real estate, is that India itself over last 10 years has not grown much. I'm sure if India's growth comes back, we all of us have been through a struggle in the last 5-10 years. Hopefully, we are probably at the bottom.
No, it's been a struggle, all right. I remember when we started the institutional desk here. I remember the Nifty was at 6350 and we tested 4400 price, and we couldn't have started off at a worse time. And I used to just sometimes wonder why this happened. But that's an interesting prognosis to hear, and we've of course had a great time interacting with your team, and so we learn as much as we go along. So Manish, just last couple of questions, and this one's come through on the Q&A chat, and I've been asked to ask this specifically in Hindi. आपका गोल्ड पे क्या आउटलुक है और आप गोल्ड में खुद इन्वेस्ट करते हैं?
नहीं देखो, सोना आई थिंक बहुत ही इंटरेस्टिंग इन्वेस्टमेंट है. आई हैव टू एडमिट, मेरा कॉल ये होता था कि 5% अपना नेटवर्थ का डाल दो कि वर्ल्ड वॉर 3 नहीं हो जाएगा तो गोल्ड ही बचाएगा. बट आई थिंक इट्स टर्न्ड आउट टू बी फिनोमिनली, बहुत अच्छा रिटर्न दिया है गोल्ड ने, कॉन्ट्रेरी टू माय एक्सपेक्टेशन. मतलब मैंने सोचा नहीं था कि इतना अच्छा रिटर्न बनेगा. एंड अभी मेरे को लगता है गोल्ड में थोड़ा एक्टिव इन्वेस्टमेंट करना चाहिए, क्योंकि जो ये सेंट्रल बैंक्स का गेम है अबाउट प्रिंटिंग सो मच मनी, तो बेसिकली आउटकम्स एक्सट्रीम एंड्स पे दो ही हो सकते हैं, कि बहुत इन्फ्लेशन हो या बहुत डिफ्लेशन हो. कि अगर इसमें कोई डाउट नहीं है कि हम लोग एक एक्सपेरिमेंट में रह रहे हैं अभी, क्योंकि जैसे ये फेड और यूरोप के बैलेंस शीट सेंट्रल बैंक के बढ़ रहे हैं, ये हिस्ट्री में कभी नहीं हुआ है. तो अगर इनका जो मॉनेटरी बैलेंस शीट एक्सपेंशन, इतना पैसा जो छाप रहे हैं, अगर इसमें तीनों पॉसिबिलिटीज हैं. एक तो कि स्टेबल इकोनॉमी हो जाए जैसे चल रहा था, वो भी है. लेट्स से 60-70% प्रोबेबिलिटी वो है कि कुछ ज्यादा फर्क नहीं पड़ेगा ये सबसे. बट ये भी पॉसिबल है कि 15-20% बहुत इन्फ्लेशन होगा, 15-20% इनके प्रिंट होने के पैसे प्रिंट होने के बाद भी डिफ्लेशन, और हम लोग फिर स्लो डाउन या ग्रेट डिप्रेशन में चले जाएं. तो ये जो दो एक्सट्रीम पॉसिबिलिटी में, दोनों में गोल्ड अच्छा करेगा. तो मेरे ख्याल से 5 की जगह 10-15% जिसका भी कॉल है. बट आई थिंक gold is interesting. I'm thoda favorably inclined, let's say.
Interesting. Thanks for that. So Manish, my final question to you now is, you are from IIT Bombay, Madras rather, IIT Madras. I am Bangalore and a mutual fund manager. One of the perfect adverts for a shadi.com had you been a bachelor. You know, IIT, IIM or paisa samajhta hai, Sona Munda hai. Now tell me, when you look at people, when you hire people today and, sort of look at how things are progressing from here on, talk to me just a little bit in conclusion about the relevance of these institutions, because there are lots of other degrees that are being done today at a local and a global level and have achieved some level of success as well. In fact, like I told you, I had interviewed Navneet on the similar platform last week, and we spoke a little bit about CFA and how people are doing that as a dual degree. But I don't think too many people in today's generation are looking for an IIT IIM combination. Executive education has become a big thing. Those who can afford it go to Ivy Leagues overseas. Uh, how do you sort of, when you're hiring talent, being an IIT IIM yourself, what do you look for in somebody, and how relevant were these institutions in making Manish Gunwani who he is today?
I think they definitely were good places to have a great time, hanging out with friends and all that. But I guess that happens in most colleges. See, I think as someone said, it's not what you did there. It's the fact that you got in. That is the only point, that as a filter, it's just a filter, right? I mean, it's not that, at least in my case, frankly, when I went into engineering, it took me probably all of 6 months to realize that was not my life. So there's nothing much I picked in engineering in 4 years, to be honest, because within the first year, I felt like finance will be more exciting than engineering. So it's not about what you learn there, to be honest. It's just the fact that if I'm a recruiter of trying to hire a person, it just gives me a filter that this person has basic quantitative skills, a basic analytical kind of framework. Frankly, to me, and I think this will become more and more important in the future, I think passion for your job is probably the single most important this thing. Assuming you have some basic degree, so I don't care whether you are IIT Indore or IIT Roorkee or whatever. I don't care. But a lot of the people I meet, at some point, I feel that they have to find their vocation. I think a lot of people don't find their vocation even till very late in their life. And I'm not saying that it needs to be only one thing for 50 years. It's okay if you like something for 10 years, then you switch to something else. But at least when you are doing it for those 10 years, you do it with the attitude of trying to excel in it or trying to be passionate about it. A lot of people I meet, they're doing things just for a job. I mean, you obviously want people who are not working at your place for a job. And it's all about, especially equities. I think equity is not something where I can say you sit in office from 9 to 7, you'll become great at it, right? I mean, I can make a guy work for 15 hours a day, but he may not become great. And it's not about becoming great. He may not really be insightful. See, sometimes the problem in equity is you are insightful, but you're either too late or too ahead of the market. Unfortunately, in a market, even if you're too ahead, you get punished.
Right.
So right or wrong is different. But I'm saying, when you look at a stock, when you look at economy, you need to have some differentiated insight, and you need to love that differentiated insight. The challenge I see is a lot of people just want to tick box saying that I've created the model, I've given the reco, but it's not differentiated. It's not something that seems to excite him itself, right? I mean, it's very difficult for someone else to be excited if a call, and again, see, in our business, 8 out of 10 calls I know will be routine. See, at this point to say lever is a buy, okay, well, it's okay. But I'm saying at least once a year or once in 2 years, and I'm not even saying it's a call. I'm just saying have a different way of looking at certain things. I think that comes only with passion. I think that is something you need to focus on. Well, at least that's what I feel. I'm just looking for people who would literally work for free just to be in the stock market, right? I mean, where even in nights, sometimes, and that's a downside, that even if you're sitting somewhere outside office, you start thinking about some part of how to look at a stock or how to look at something. It may not be good for social life, but it invariably happens actually.
No, that's interesting. In fact, one of the sentences that you said took me back to a line from the movie Three Idiots, where it says, "जब दोस्त fail होता है तो बुरा लगता है, जब दोस्त first आता है तो और भी अच्छा लगता है." So it's been fascinating chatting, Manish. I think it's been very informative. I think it's given us a good insight into the way you approach things and the market. I hope you enjoyed this broadcast.
Very nice. Thanks for having me.
Thank you so much for doing this, and good luck. Stay safe. More power to you and your fund, and hope to see you soon in person on the other side once this subsides.
Sure. Thanks everyone, and stay safe. I mean, that's very important.
Absolutely. And thank you so much to all the participants who've logged in as well. Thank you so much for sending in your questions and being active participants on this chat. Thank you so much to everyone.